Hi, this is Ed Ponzi, President of FX Educator. Welcome to the course. Today we're going to learn an awful lot about foreign exchange, about technical analysis, risk management, fundamentals, and especially strategies. I'd like to thank you for taking the time and the effort for learning more about the foreign exchange opportunity. Just a little bit about me. Again, my name is Ed Ponzi. I'm the president of FX Educator and the former chief trading instructor at FXCM. You may know me from seminars that I've given around the world, one-on-one training that I've provided, or my appearances on several websites, especially FX Street, who is the sponsor of today's presentation. If you haven't checked out FX Street, please give it a look, because they have everything that individual traders can take advantage of, such as real-time quotes and charts, expert question and answer sessions, news and analysis, and much more. And in addition to that, there is a new service, FX Street Premium, and they offer live education. You'll see me on there quite a bit. As in addition to that, real-time charts, expert commentary, all live in real time. So please have a look at fxstreet.com. It's a great site, and I think you'll find it very, very useful. So let's talk a little bit about the foreign exchange market. You have probably heard the terms FX, currency trading, Forex. Those all mean the same thing. Those are all different terms for foreign exchange. And chances are that you have already performed a currency transaction at some point in your life. If you've ever traveled overseas or if you've ever visited another country, you've probably had to exchange your currency for the currency of the country you were visiting. And I want you to think about that for a minute. When you do that, when you go to another country and you hand over your currency and you receive another currency back in return, there are two currencies involved in that transaction, but there's only one exchange rate. Keep that in the back of your mind, because we're going to refer back to that as we go along. You see, that's the reason why we trade in pairs, because a currency cannot fluctuate in and of itself. Think of this situation. Can we trade one currency back and forth, you and I, between us? In other words, I have 20 US dollars. How many US dollars will you give me for 20 US dollars? I have a feeling you'll probably offer me 19, but I'm not going to accept that. And on the other hand, you're not going to offer me 21. You're only going to offer me $20 for $20. So you see what I mean? We cannot trade the dollar back and forth between ourselves. It doesn't fluctuate in and of itself. But the US dollar and other currencies are constantly fluctuating among each other. And that's where the opportunity takes hold. For example, let's take a look at how currency transactions in everyday life might occur. Consider this. A tourist from the United States flies to Canada. And when this tourist arrives in Canada at the airport, the tourist takes 1,000 US dollars out of pocket, hands it to the man behind the counter, and receives in return 1,250 Canadian dollars. Two currencies, one exchange rate. The exchange rate is 1.25, because for every one US dollar, the tourist received back 1.25 Canadian dollars. Note again, there are two currencies involved, just one exchange rate. So let's imagine that our tourist also visited Canada last year and realizes that he received 1,500 Canadian dollars in exchange for 1,000 US dollars last year. This is working against our tourist. The exchange rate has fallen from 1.5 to 1.25. So his US dollars buy fewer Canadian dollars, and we could say that the US dollar has weakened in relation to the Canadian dollar. And that has worked against our tourist. Let's take a look at the similar situation. This time, let's suppose that a woman moves from the United States to Canada. The exchange rate is 1.5. So let's assume this person believes she'll be staying in Canada from now on. So she's going to exchange her entire savings from US dollars over to Canadian dollars. She takes 100,000 US dollars, her nest egg, and exchanges it for 150,000 Canadian dollars. So obviously the exchange rate is 1.5. Now, a year passes, and this individual decides, for whatever reason, that she wants to move back to the United States from Canada. She still has her 150,000 Canadian dollars sitting in a Canadian bank, and she wants to exchange that now back to US dollars. However, the exchange rate has changed. It's fallen from 1.5 to 1.25. So, she takes her 150,000 Canadian dollars and receives 120,000 US dollars, because 150,000 divided by 1.25, the new exchange rate, is 120,000. So she actually profited $20,000, really without even trying, just because the exchange rate moved from 1.5 to 1.25. So you can see how the same move in exchange rates benefited one person and had a negative impact on another. Now, here's the thing. That $20,000 gain on a $100,000 investment, in other words, that's a 20% return that she achieved just from holding that money in Canadian dollars for a year. She really wasn't trading, she didn't use any leverage. It just worked out that she held the stronger currency, and because of that, she benefited a great deal. Now, currency traders often use leverage of 100 to 1 or even higher. So, at 100 to 1 leverage, in other words, the same gain could have been achieved, but the trader does not have to put up 100,000 US dollars. A trader would only have to put up 1,000 US dollars to gain the 20,000 from that exchange rate. So you can see how leverage can benefit a trader. Understand very carefully, though, that leverage is a double-edged sword. It can also work against you. But the type of profit opportunities that we're talking about are the exact reason why people are excited about trading the foreign exchange markets. And now that we're getting involved in Forex, it's important that you understand the differences between foreign exchange and the stock market or the futures market. For example, in the foreign exchange market, stops are guaranteed by many of the market makers under many conditions. That's something that you really can't get anywhere else, and it's a huge edge. Also, if you're a trend-following trader, the Forex market is known for strong, persistent trends that can last for months or even years. Okay, so again, that's a huge advantage if you're trading that type of style. And we're going to show you some techniques as we go along for following the trend and how to trade it. We just spoke about leverage very briefly. Leverage is available of 100 to 1, 200 to 1, in some cases even greater. Now, please understand, you don't have to use that degree of leverage if you don't want to. Okay, but it is available. No one's going to try to make you use leverage that you're not comfortable with, and you shouldn't use any type of leverage that you're not comfortable with. Okay, so please just be aware of that. You can use as little leverage as you like. Actually, you don't have to use leverage at all. But as we'll see as we go along, leverage is used in this market on a daily basis by most traders, and there are very good reasons for that. In addition to this, tremendous liquidity in this market. The equivalent of 1.9 trillion US dollars per day trades in the foreign exchange market. That is a huge amount. It makes it much larger and more liquid than any stock market and any futures market out there. Also, there's no directional bias to trading Forex. If you want to go long, you can go long, and if you want to go short, you can go short just as easily. Equities traders know that there are many rules in regard to that you must deal with. As an equity trader, you have to have an uptick to sell short, for example. That's not something that I have to worry about as a foreign exchange trader. Also, it's a 24-hour market, so no matter where you're located in the world, you can always trade foreign exchange. You do not have to conform to certain market hours. The market hours are always available. It's just a matter of what time you wish to trade And we're going to take a look later on as we go at the most beneficial times to trade as well. So in addition to this, information about your currency is readily available. This is very different from the stock market. I used to trade equities, and I can tell you that many times we would see a stock begin to move, and we really didn't know why. We're looking for the news. We really don't know why this stock is moving. And we'll be searching the news wires, looking for any piece of information or any rumors. But in foreign exchange, it's much more visible. It's much easier to see what's going on because we're not trading companies. We're trading entire economies here. So it's obviously much easier to obtain that information. In addition, it's considerably less complicated in the sense that I don't have to know how to read a balance sheet to trade foreign exchange. Okay? In the foreign exchange market, I don't have to worry about what type of accounting methods are being used. It's much easier, it's much simpler, and again, much more transparent. I also have the ability to trade news and events. And being a 24-hour market, the Forex market is open pretty much any time that any news event occurs. So if you're the type of trader who thrives on trading news and events, this is definitely a market that you have to take a very close look at. In addition, I never have to worry that a currency is going to be halted while I'm trading it. And if you equity traders know what I mean, if you've ever been long or short a stock and that stock was halted, you're trapped in that stock and you can't get out, and it's liable to make a big move either for you or against you before you can get out of that stock. This is something that I simply don't have to worry about in the Forex market. So we can see that there are many advantages to trading Forex. Now, once we begin trading, we have to take a look at the different entities that we're going to be trading. And we're going to focus on the major currencies of the world, okay, the countries that are going to provide the most liquidity. The most widely traded currencies are certainly the euro, the Great Britain pound, the US dollar, and the Japanese yen. And in addition to these, the Swiss franc, the Canadian dollar, the Australian dollar, and the New Zealand dollar. Now, of course, we don't trade these in and of themselves, as we discussed earlier. We have to trade them in pairs because they fluctuate against each other. So here's a look at some of the more popular currency pairs. This is by no means a comprehensive listing. There are many more currency pairs available. However, these are the more popular, the more well-known, the more liquid pairs that are out there. And if you're just getting started, you're probably going to want to stick to these pairs before you branch out. Now, when we talk about a currency pair, I want you to think of it as one unit. For example, when you think of a stock, like for example, IBM stock, that stock is one unit. IBM is going up, IBM is going down, it's one unit. Think of the currency pair the same way. The Euro-US dollar currency pair is one unit. The exchange rate moves up or it moves down. Now, there are two currencies in every pair. The first member of each pair is called the base currency. The second member of every pair is called the counter or quote currency. And whenever the exchange rate rises, that means that the base currency, the first member of the pair, is strengthening versus the second member of the pair. If, on the other hand, the exchange rate is falling, that means that the counter currency is strengthening and the base currency is the one that is falling. So if we take a look at a chart, for example, and we see that the exchange rate is rising, that means that the base currency is strengthening versus the counter currency. Doesn't matter which pair you're trading, that is always true. That's a constant. Let's talk about the basics of foreign exchange. You've heard me refer to the exchange rate, but that is often referred to as the price. It's not really the price, it's really the exchange rate. However, you will hear me and other traders often refer to the exchange rate as the price. Technically, that's not correct, but that is the slang that traders use. So let's assume for our purposes that right now 1 euro is equal to 1.21 US dollars, or $1.21. Then we could say that the exchange rate between the euro and the US dollar is 1.21. However, we're going to carry that out 2 more decimal places. For example, we could express it as 1.2125. So we're carrying it out 2 more spaces. And the smallest increment of change, that last place, that last digit, those are pips. So, for example, the euro-US dollar has an average daily range of approximately 100 pips per day. Now, in the currency market, if you're trading on a US dollar denominated account, 100 pips of the euro-US dollar currency pair is the equivalent value of 1,000 US dollars. So in other words, you could say that 100 pips a day is the average daily range for that pair, and that is equal to $1,000 from top to bottom on the average daily range. What I would like you to do is to think of the first member of the pair as the number 1. For example, if the euro-US dollar exchange rate is 1.2125, we could say that 1 euro equals 1.2125 US dollars. Always keep that in mind because it makes it easier to understand the exchange rate. Let's assume that the exchange rate changes. It increases from 1.2125 to 1.2126. That is a 1 pip increase. That is the smallest move that it can make. So, the euro-US dollar currency pair, 1 pip is actually equal to approximately 1/100th of a penny, because remember, we carried it out 2 extra spaces. Okay, we carried it out to 4 decimal spaces. So 1 pip is actually, in real life, the equivalent of 1/100th of a penny, approximately. But because of the tremendous leverage that we spoke about earlier, we magnify that 1/100th of a penny, and now, in a US standard account, 1 pip of the euro-US dollar currency pair is worth 10 US dollars. A big difference, because you're saying right now, Ed, you're crazy. Why would I trade 1/100th of a penny? What's the point? Very true. It doesn't make any sense unless you're magnifying that with leverage. That's why the leverage is so key. So through using that magnifying glass of leverage, we're taking that tiny move in exchange rate, and that tiniest move is 1 pip, but because of leverage, that 1 pip move has a value of 10 US dollars. Let's talk about the spread for a moment. Every trading instrument, whether it's a stock, futures, or foreign exchange, has a buy price and a sell price. The difference between these two is called the spread. Most currency platforms offer a fixed spread, so you can say in many cases that perhaps a currency pair has a 3 pip spread, for example. I want you to think of the spread as the cost of doing business. In other words, most of the currency trading platforms that are available today do not charge commissions or data fees or any other type of outside fees. They just charge the spread. That's how the market maker gets paid. That's the cost of doing business. So your goal as a trader is to overcome the spread. Once you've overcome the spread, you've broken even, and now you can start to make profit. Let's have a few words about trading terminology. Long, short, and flat are very important trading terms that I want to cover with you very briefly. For example, if I say that I'm long, that means I'm going to profit from a rising exchange rate. If I'm long the euro-US dollar, I want the exchange rate to rise. Short is the opposite of long. That means that I'll profit from a falling exchange rate. So, if I'm short the euro-US dollar, I'm essentially betting that the euro-US dollar currency pair is going to fall in value. The exchange rate is going to fall. If I'm flat, that means that I'm neither long nor short. Now, you might be thinking right now, Ed, why are we using long and short? Can't I just say the words buy or sell? Let's think about that for a minute. How come I just don't use the word buy? How come I'm saying long? Think about it this way. If you ask me, Ed, what are you doing with the euro-US dollar today? Are you buying or selling? And I tell you I'm buying. Couldn't that mean 2 different things? Think about it. It could mean that I'm buying it because I think it's going to rise, the exchange rate's going to go up, or maybe I'm already short and I'm buying it to cover my position so that I can go flat. It could mean two different things. However, if I tell you that I'm long the euro US dollar, there's no mistaking my meaning. I'm essentially believing that the euro is going to strengthen against the US dollar and that the exchange rate is going to rise and that I will benefit from a rise in that exchange rate. There's absolutely no confusion. That's why we use the terms long and short instead of buy and sell. Now, other trading terminology that you must be familiar with. Entry, that's self-descriptive, it's the point of entry where we're going to enter the trade. Target is your goal for the trade. Every trade should have a target, and as we go, we'll show you how to create those targets. Stop is an order that takes you out of a trade that's going against you. It prevents a catastrophic loss, and it's very important that we use a stop on every trade. You'll hear the term lot. What does that mean? That's one trading unit. For example, in the futures market, we trade contracts. In the stock market, we trade shares. In the foreign exchange market, we trade lots, and the smallest size trade is one lot. Currencies have different nicknames, and it's important that you understand them because obviously if you're speaking to another trader or you're reading a magazine article perhaps, and if you see one of these terms, it's obviously important to know what they are. The US dollar is often referred to as the greenback or the buck. The British pound is often called the cable or the sterling. You'll hear the euro referred to as the single currency because it is a single currency that is used by many countries. The Canadian dollar is called the loonie because on a dollar coin in Canada there's a picture of a bird that is a loon. And the New Zealand dollar is referred to as the kiwi. So just to review some Forex basics here, the currencies fluctuate in relation to each other. The currencies always trade in pairs. The base currency is always the first member of the pair. The counter currency is always the second member of the pair. And think of the base currency as the number one. For example, if you take a look at this shot of the trading station, 1 euro equals 1.2123 US dollars. That's not too hard, right? 1 US dollar equals 109.42 Japanese yen. 1 Great Britain pound equals 1.8057 US dollars, and so on. Let's take a look at an example of how this might work in a real trade. For example, let's assume that the Euro USD has a current sell price of 1.2122 and a current buy price of 1.2125. Let's go long the currency pair. In other words, buy the currency pair Euro US dollar, and we pay 1.2125. In order to break even, since this pair has a 3-pip spread, we need the sell price to move up and equal our buy price. Our buy price was 1.2125. We need the sell price to rise to 1.2125 and the buy price to rise to 1.2128. In other words, we need to overcome the spread, and a 3-pip move in our favor will compensate for that spread. Let's assume that this occurs and the trade continues to move in our favor. The trader exits when the Euro US dollar exchange rate equals 1.2135 on the sell side, 1.2138 on the buy side. The trader's profit would be 10 pips if we exit at 1.2135. So, a 10 pip move in the Euro US dollar currency pair is going to net the trader $100 in a US dollar standard account. And there are mini accounts available too. We'll speak about them later. But a 10 pip move in the Euro US dollar currency pair is going to equal $10 in a mini account. And again, that's for a US dollar denominated account. What about the value of a pip? This is determined by the currency pair that you're trading and by the current exchange rate. Now, if you're trading in a US dollar account, all currency pairs ending with US dollar have a constant pip value of $10 in a US dollar standard account. For example, Great Britain pound US dollar is always worth $10 per pip. Euro US dollar, same thing. Now, let's assume you're not trading a US dollar denominated account. Perhaps you live in London and you're trading a Great Britain pound denominated account. In this case, any pair ending with Great Britain pound has a constant pip value of 10 British pounds. For example, the Euro Great Britain pound pair has a constant value of 10 British pounds per pip in a Great Britain pound denominated account. It's very easy, by the way, to determine the value of a pip. Most trading platforms have a pip cost column on the dealing rates window. So, for example, in this graphic, you can see that the various currency pairs are listed on the left. If you look toward your right, there's a column, pip cost, and in that column is the value of a pip for that particular currency pair. Let's talk a little bit about the trading day itself. Now, Forex trades 24 hours a day, but we can break that up into different pieces, determined by the different countries and the different currencies that are active at certain times of day. The time of day is normally expressed in GMT, that's Greenwich Mean Time. Why do we use GMT? Well, it's because traders who trade the foreign exchange market are located all around the world, and they trade any time of day they want. So in order to have a common point of reference, we use Greenwich Mean Time. The trading day begins and ends at 2100 GMT or 2200 GMT, depending on daylight savings time. So during daylight savings time, it's 2100 GMT. When you're not during daylight savings time, in other words, when you're on standard time, it's 2200 GMT. This is going to equate to about 10 p.m. London time or 5 p.m. New York time. Why does the trading day begin at such an odd hour? Well, due to the international date line, it is morning in Australia before it is morning in, for example, Japan or Europe or the UK or the United States. So at 5 p.m. Eastern Time on Sunday, when I'm having dinner in New York, it's Monday morning in Australia, and trading is now becoming active. That's why that particular time of day is used to denominate the beginning and the end of the trading day. And if you take a look at this graph, you'll see that the different times of day are listed for various parts of the world. What I want to point out to you here is that they're not exact times of day because Forex is a 24-hour market. It's not as if a bell is rung and trading commences in a particular part of the world. Traders can trade anytime they want to, but a particular country tends to become active at a time when the people wake up and begin trading. So think of these as general times. Remember, there's no opening bell in the Forex market. Let's talk about those active trading times. 2300 GMT, that's generally morning in Tokyo. And that Tokyo is very significant because Tokyo accounts for about 10% of all foreign exchange volume. A few hours later, 7 GMT, now it's morning in Europe and in London. And London is a huge Forex trading, let's call it the Forex trading capital of the world, because 30% of all Forex transactions emanate from this part of the world. So as Japan winds down, Europe and London kick into gear. While trading in the London session is ongoing, traders in the United States become active. Around lunchtime in London, around 12 GMT, it's now morning in New York. New York accounts for about 20% of all Forex trading volume. So you now have a time of day where trading overlaps in London and in the US. So there's an awful lot of volume going back and forth because the London session and the US session overlap. I want to talk to you for a minute about chart formations, and we're going to do a lot of technical analysis as we continue on with the course. But I just want you to know that, especially if you're new to Forex trading, perhaps you've traded stocks or you've traded futures at some point, and maybe you've looked at charts and Maybe you're worried or wondering about Forex charts. What do they look like? I mean, there are two currencies involved in a pair. What does that look like on a chart? Well, I think you're going to be pleasantly surprised. You do not have to relearn technical analysis to trade Forex. Okay, Forex charts contain double tops, head and shoulders formations, other familiar technical formations. In other words, you've seen all this before. The reason why that the formations are the same in Forex as in other trading vehicles is simple. Those formations are not based on the instrument that is being traded. Those formations are based on human psychology. So, if I see a double top formation, such as in the Euro-US dollar pair, it's very likely to occur. In fact, you see a lot of double tops in that particular pair, a lot of double tops and double bottoms. In addition to that, head and shoulders formations also occur in the Forex market. You will see support levels and resistance levels in Forex the same way that they appear in the equity market and the futures market. Also, channel trading happens very frequently in Forex. You find well-defined support and resistance levels that develop into channels. In this particular case, we're looking at the US dollar Swiss franc. You can see that there's an upward channel. It ends with a double top and then a downward channel. The cup and handle formation is something that occurs occasionally in the Forex market. So if you're a trader who uses those type of formations, you'll be pleasantly surprised. You do not have to relearn technical analysis. We spoke earlier about trends. Trends can go on for a very long time in the Forex market, for years. And that's very advantageous to trend following traders. So we'll look for those on charts as well. Fibonacci is something that Forex traders use quite a bit. In fact, let's call it a part of the Forex culture. And as we continue with the course, you're going to see some Fibonacci strategy that I think you're going to enjoy using. And of course, moving averages and other indicators. We use the same exact indicators in the Forex market that are used in stocks and futures and otherwise. So you see, the Forex market is not all that different from trading equities and futures. You don't have to relearn technical analysis. You'll be pleasantly surprised, and hopefully it's something that we're all going to use to our advantage.